Hi everyone, this is Rob Roy and welcome to the Elliott Elite U.S. Market Update. Just wanted to catch you up to date on the last just over a week's worth of trade. We were closed on last Friday, so we had a holiday shortened week, and then I wanted to catch the beginning of the week for this report because Monday was the first trading day of a new month and the first trading day of a new quarter. So typically that is an up day. The way things work with the managed accounts here in the U.S. with our IRAs, 401ks, investment contracts, investment vehicles that are usually managed through some sort of a mutual fund type of a investment. It's very common for those institutions to put new money to work for the month on the first trading day of the month. In other words, you've got people that are funding through dollar cost averaging, just automatic payment plans, putting money into their retirement accounts or investment accounts, and then the institutions gather that, and then they don't just consistently buy throughout the month. They normally will buy at the first trading day of the month. So we're sitting down here on Thursday's close, and then we had the holiday on Friday. So then on Monday, you can see that was certainly not an up day. It was a big down day. We opened about flat and then just sold off throughout the day, bounced a little bit at the end, and then Tuesday and Wednesday we've moved back to the upside just a bit, but we still haven't taken out the high from Thursday. So even with as good a trading day as it seemed we had today on Wednesday, we still got a lot of work to do. We're still kind of just in a basing pattern, but if you're bullish on the market, that's what you want. You want to see some stability. You want to see this basing here without new lows. We talked before about the different types of testing of lows that you can have. The first one was what would be evidenced here with this bar that occurred on the 2nd of April, which was Monday, where we came down and stopped just short of the low that occurred back on the 9th of February. Sometimes you come down and you hit that the previous low exactly when you're testing a low, and then sometimes you break the low, and I kind of like that atmosphere when you're testing a low, was when you break the previous low, then all of a sudden it scares the heck out of everybody. Everybody's like, oh no, we're taking another leg down. We're not just testing the low, we're making a new leg down, and people tend to panic. Then they really dump. You have massive volatility, huge selling, and then you get the reversal. And those are bottoms that really tend to hold. Now, this could very well be the end of the selling for this round. Maybe we base for a while and then head back to the upside. We'll just have to wait and see. But it is a qualified test, just stopping just short. And I know it sounds like, oh, well, you covered everything, just short, exact low or lower low. But, I mean, that's how it works. All three of them are viable. And the reason that this one works is a lot of times people are waiting for, well, we got to get down to where the low was before, and then the longs come in and they get a jump on everybody else, and they buy early and catch a bigger run than people that are sitting on their hands waiting for the actual low to have a print. So I wanted to go back and remind you, we were talking about this pattern way back where we had the potential for a zigzag setup, and we talked about that 78.6% level and that it had to be hit. And of course, I'm sure if you've been following along and using your fib retracement tool with Profit Source or Integrated Investor, hopefully you are by now. If I haven't shown you how powerful they are by this point, I'm not sure what it would take. But hopefully you're doing that in your own trading and analysis. But you can see that we did on both actually the 12th and the 13th of March touch that 78.6% level dead on the nose. So remember what that means. That means that this potential, and just erased it, so I'll draw it right back up here. This potential downward zigzag pattern was disqualified. So we are no longer looking for the market to go down and make a new low. Now it still might, but it won't be because it's a qualified zigzag pattern. We'll just have to wait and see. But it does give a little more credence to the point that maybe we're basing now, and we've got some support building in down here in this area, save for that little tail here on the 9th of February. But we are building a little bit of support there, and I live on the Space Coast in Florida, so I quite often will talk about this sort of a basing pattern where you go dead sideways is a bit of a launch pad effect, where you go sideways for a while, it's very flat, and then all of a sudden the market, the individual equity, whatever, blasts off and takes off from that base that it's built. So that's what appears to be going on right now. We'll see how that plays out, but I wanted to remind you that the power of Elliott wave, even though it's no longer a qualified zigzag pattern, it is helping in your technical analysis to know that, hey, we have a disqualified zigzag. We don't expect a new C low. So we may very well find some support in this area, and you can watch for that. And also want to point out this gap that exists right here that hasn't been filled yet. And gaps get filled. They just do. There's no real rhyme or reason for why they do. There's lots of different theories out there, and it's all speculation in my opinion, so we won't go into it, but they get filled, and we're likely going to see that one get filled. And then one day we will actually get all the way back up and make new highs and fill this gap that exists here as well, but obviously that one's probably a lot further off. So we take a look at the SPY so we can bring volume into the mix. And you can see that this basing here is on high volume, which is interesting. And that's because there's a battle going on down here at these previous lows where the shorts are trying to push it down because they know what will happen if we break that low. They get the panic selling that I just talked about. Obviously, the shorts want that. And the longs are trying to hold this level and build this support, so the shorts are forced to cover, and then we get the big move to the upside. So the higher volume on this sideways pattern here is showing the battle between the longs and the shorts taking place. Also wanted to come back up here and bring this 200-day moving average back on here and show you that we had one close below the 200-day moving average that occurred on Monday. But remember, and we've talked about this before, and you'll hear me say it over and over and over again, whenever you're breaking a major support or resistance level, it takes 2 consecutive closes in the direction of whatever is being broken. In this case, it's the 200-day moving average, so the move is to the downside. So you would need 2 consecutive lower closes in order to have a qualified break. So right now, this is would be a test of the 200-day moving average, even though we did get a close below it. We did not get the second close, the follow-through day or confirmation day, and so therefore it just counts as a test of the 200-day moving average, not really a legitimate break. Going back to the VIX, we're coming back down, but again, as we are really excited about, it does appear that we're building now the 15 level, which just means that we're returning to more normal volatility. There's a investment manager that I respect quite a bit was on CNBC today, Jeffrey Gundlach. He says we are in a new regime of volatility, and that is ideal for option traders. That's what we want. We want these markets moving, and that's perfect environment for trading options, especially when we have our directional patterns and then the non-directional triangles. Both of them is great for both different types of trading strategies. So when looking here, you can see that even with the big rally, we still closed at a 20 on the VIX. We're not even down towards that 15 level, but look to see that 15 becomes support probably for the foreseeable future, maybe even for the balance of the year at least. Also wanted to bring up a chart of the dollar, which is still doing absolutely nothing. Very surprising to see that with the Federal Reserve coming out, talking about raising rates, better economic conditions. We had the ADP, which is the preface to the big jobs report. Friday we get the big jobs report here in the U.S., but the ADP is a private company rather than the government's number. And it's funny how they don't always agree. Isn't that interesting? It should be black and white, whether it's a private company or the government identifying how many jobs are being created, but they quite often vary. But it was an extremely good report, one of the best ones I've seen really in 20 years, not exaggerating, as far as where we are with fuller employment and in the types of jobs that are being added in both those factors. It's a very solid jobs report. Not enough to prop up the dollar, though, and pretty interesting. There's all kinds of conspiracy theories behind the scenes of currency manipulation by central banks, etc. And I'm not going to get into that, other than when you see stuff like this, it does make you wonder. Now, possibly we're just going through embasing here. Maybe we're just having a really good basing period with the dollar, and then it gives that little launch pad effect that I was talking about and blast to the upside. We'll wait and see how that plays out. TNX, and as you would imagine, with the dollar not doing much, interest rates aren't doing much either. This is interesting for a different reason, because we talked about the economy that exists with interest rates when you see the market going down like this, because when money gets scared, it wants to run into bonds. That's the hiding place. When you're worried about equities, you run into bonds, and so buying bonds pushes rates down. But then you have the Federal Reserve raising rates, you have a better economy. Those things tend to normally push rates up, and we're still in this dead sideways type of an environment here on rates. A little bit of a move to the downside, and you can see Monday with the big sell-off. See what I mean about the lower move in interest rates, which coincided with a big down day in the markets, and then we get a couple up days and we bounce back up a little bit. But we're going to break out of this sideways malaise at some point. Then I also wanted to talk about another case study that we're looking at. The energy sector has not followed along at all with the rest of the U.S. market. It didn't move to the upside with the rest of the sectors. It's been lagging behind, and we kind of have this little bit of a sideways basing pattern here as well. But this is interesting, and what I wanted to show you is right through this area here, you have all of that support resistance right there around the 120 level. You can see that it did rally back in December, January, but prior to that, the energy sector wasn't doing well. But this stock was doing a little bit better. So that's your reference level. And then what we have, and I don't talk about these very often because they tend to be sideways type of technicals, but it's another one of those corrective patterns within Elliott wave that I've talked about: flats, zigzags, and triangles. And we've done a lot of talking about zigzags and triangles, not very much about flats. So I wanted to show you a flat here. So we break this area here that was resistance and moved up, so it should have been support. It wasn't. We went right through it with no problem, and now we've created this sideways flat pattern, and the way it's labeled is A, B here, and then C lower. And it's just a sideways pattern, but it's a sideways pattern with a stock that it should be poised with prices of oil going up. Its sector, the energy sector, has underperformed the rest of the market greatly, even with this move that this stock had at the beginning of the year. And it looks like this could be a potential to move to the upside from here. So what's neat about flats, if you wanted to create a directional trade, now obviously we don't have a zigzag to trade or any sort of a five-wave Elliott wave pattern, the more traditional. We don't have any of that, but what we do have with a flat is a really good reference for risk management. So right there at 110 would be the low. So if you wanted to put on a long position, which we did, your stop loss is if you break 110. So if that C breaks this 110 level, you close your position out. So you have a very small amount of risk in an options trade, and then you have big potential to the upside. If it were to break back above 120, there's no resistance before it gets back up to the previous highs in the 130 to 135 area. So it's a low risk, high potential return type of trade, and it's based off of looking at the flat pattern. Again, you won't see me identify too many of those because they're mostly associated with trades that you expect to move sideways. I don't like to trade sideways type of strategies, but in this case, the sideways pattern looks like it's completing, and we could get a directional pattern from here. So it's a little bit of a twist on what we normally talk about, so I wanted to share that with you as well. Again, we like to look at things ahead of time. And then last but not least, real quick, this one's getting pretty long-winded, but I wanted to show you the progress of the other case study that we have with PAYCOM, PAYC, expecting that to come back down and hit this area here. That's where the previous fib level was. If you remember, we showed that numerous times, and that's working out extremely well. So we'll take another look at that one next week. Just wanted to give you a quick update, but the position is profitable. It's doing very well, and the stock's doing exactly what it's supposed to do, again, based on Fibonacci level. So hope you've all had a good week, and we're back to talk to you again next week. Take care, everybody.